Welcome to the Explainer. So, have you ever opened up your portfolio, stared at a horrifying sea of red, and thought, what on earth just happened? Well, today we're diving into the absurdly interconnected, hypersensitive Rube Goldberg machine we call monetary policy. We're going to look at how a handful of economists sitting around a mahogany table, tweaking a tiny little dial, can somehow cause a massive chain reaction that absolutely nukes your personal net worth. It's a wonderfully sarcastic reality, and today we're mapping out exactly how this whole ridiculous contraption works. Seriously, think about it. Why does a measly 0.25% rate hike, literally a microscopic bureaucratic tweak to a decimal point, cause the global stock market to throw an absolute toddler-level tantrum? How does a quarter of a percent just vaporize trillions of dollars? Well, it's because money isn't just dead paper, right? It's a living, breathing mechanism, and when you mess with the cost of that money, you fundamentally alter the gravity of the entire financial universe. So here's the blueprint for our machine today. We'll start with the magic money faucet, move into the great economic chain reaction, look at the cruel seesaw of bonds, see where gravity finally kicks in for stocks, and finish up with capital flows and the global vacuum. All right, section 1, the magic money faucet. Let's talk about how central banks actually control the initial flow of cash. Okay, so the base rate or policy rate. Basically, this is the benchmark interest rate central banks use to lend to other banks. Think of it as the central bank's absolute favorite, giant, comical lever. When the economy is running a little too hot, or inflation starts violently chewing through our wallets, they reach for this exact lever. It's the primary valve for the entire economy's money supply. And that valve basically has two modes. First, you've got expansionary policy. The central bank cranks the base rate down. Suddenly, borrowing is dirt cheap, saving feels like a total waste of time, and boom, everyone is out there spending like crazy. But then they flip it to restrictive policy. Rates shoot up, borrowing becomes painfully expensive, and out of nowhere, hoarding cash in a basic savings account looks like the smartest thing you could possibly do. Because retail banks just pass these base costs directly on to us. They're essentially deciding for us whether we should go get a mortgage and buy a jet ski or stuff our cash under the mattress and hunker down for winter. Moving on to section 2, the great economic chain reaction. This is where dry academic theory violently slams into the real world. Right, so here's the formal jargon, courtesy of Wikipedia's painfully dry definition. The interest rate channel. This is a mechanism where short-term nominal rates affect real rates, which alters the cost of capital, changing investment, and finally aggregate demand. Are you asleep yet? Because I almost am. But hey, economists have a special talent for making pure chaos sound incredibly boring. Just think about this hilariously unreadable equation for a second. Money supply goes up, leading to real interest rates going down, leading to investment going up, leading to aggregate output going up. M up, IR down, you get the point. This is literally the magic spell these economists use to explain the universe. But let's go ahead and translate these academic hieroglyphs into something we actually feel in our bank accounts. Okay, here's how this plays out in reality. Step 1, the central bank confidently pulls their giant lever to hike rates. Step 2, borrowing immediately gets terribly expensive for absolutely everyone. Step 3, companies suddenly realize, oh wow, we actually can't afford to finance that shiny new factory. So they just stop buying stuff, they stop hiring. And step 4, aggregate demand absolutely plummets. That is the cynical, real-world pain of tight monetary policy. It is literally designed to slow things down by making money just too darn expensive to use. Which brings us to section 3, bonds. Welcome to the cruel seesaw of fixed income. So, according to the PIMCO report we looked at, bond prices and interest rates have this brutal inverse relationship. Just picture a seesaw. When rates go up, bond prices go down. Why? Well, imagine you're holding old bonds locked at some pitiful, outdated coupon rate, let's say 2%. They are practically useless compared to the shiny new bonds hitting the market with juicy 5% yields. To convince literally anyone to buy your boring old 2% bond, you're going to have to sell it to them at a massive, massive discount. Let's run the actual fixed income math here, straight from our sources. Say you're holding a $1,000 bond, right? It pays a fixed interest of $50 a year, a solid 5% yield. You're feeling great about your life. But suddenly, the market interest rate ticks up to 6%. For a new investor to get a 6% return out of your fixed $50 payment, the market mathematically forces the price of your bond down to $833, just like that. Because some central banker cleared their throat and hiked rates by 1%, your perfectly safe asset just magically evaporated nearly 17% of its value. Cruel, right? Absolutely cruel. But, the real world doesn't always play by textbook rules. If you look at bond returns during various cycles, like on the Thai Stock Exchange, for instance, you see some major disruptions. Even in falling rate environments where bonds should be making you money, you get periods like government shutdowns that just crush returns. And in rising rate environments, you get political shifts like the Trump effect, totally overriding expectations. Now, we're not taking political sides here, but what this brilliant history lesson shows us is that despite our perfect mathematical economic seesaws, sheer political chaos can and will throw a massive wrench into the machine. Market rules are really just suggestions until reality hits.
Okay, I won't leave you totally depressed. As PIMCO points out, there is a tiny silver lining here. Yes, rising rates absolutely crush your portfolio's value in the short run, but over the long run, you actually get to reinvest the cash from your maturing bonds at those brand new, super juicy high rates. So, while the rest of the market is literally burning to the ground today, your future compound interest is quietly in the background, hitting the gym and getting stronger.
All right, section 4, stocks. This is where gravity finally kicks in, and those sky-high valuations come crashing down.
100. That number represents 100 basis point or 1% surge in the U.S. Treasury 10-year yield that recently completely shocked investors. For years, we were all living in this zero-rate fever dream, right? Money was practically free and stock valuations were touching the moon. But the second rate surged just 100 basis points, investors violently woke up from that dream.
So why exactly do stocks fall when rates rise? It's pretty straightforward. First, higher borrowing costs just eat straight into corporate profits. Second, and this is the brutal math part, stock prices are really just discounted future cash flows. Higher rates mean those future profits are worth way less today. Third, it's about competition. If government bonds are suddenly guaranteeing you a risk-free 5%, why on earth would you risk your life savings on some hyper-volatile tech stock? You wouldn't. You dump the stock and you buy the bond. It's a no-brainer. So why do economies even bother putting up with this pain? Well, research from the Evergrande Institute highlights a really fascinating comparison. Developing economies often lean on a credit channel. That's literally just the government telling banks, hey, lend exactly this much money. It is incredibly clunky, and honestly, it almost always just inflates these massive, terrifying real estate bubbles. Mature economies, though, they prefer the interest rate channel. Sure, it causes brutal stock market crashes when rates go up, but it's market-driven. It forces capital to actually evaluate risk, which ultimately funds genuine technological innovation instead of just blindly pumping up suburban housing prices. Basically, it's the bitter medicine you have to swallow to keep an economy healthy. Moving to our final section, Section 5, Capital Flows. Prepare yourself for the global vacuum. According to a working paper from the Bank for International Settlements, global capital is totally at the mercy of push and pull factors. Think of it like a really cynical game of tug-of-war. Pull factors are domestic. That's like a local emerging market offering super high interest rates to suck foreign money in. But push factors are external, things like U.S. interest rates. When the U.S. Federal Reserve decides to hike rates, it acts like a giant, unstoppable vacuum cleaner. It indiscriminately rips money right out of local emerging markets and sucks it straight back into the United States. And this vacuum effect is just devastating. U.S. rate hikes pull capital straight out of emerging markets. If the interest rate differential between an emerging market and the U.S. narrows, even a little, capital flight triggers instantly. Everyone heads for the exits. And this leaves local central bankers facing a completely cruel intratemporal trade-off. They've got a brutal choice. Do they hike their own rates to stop capital flight today, which totally crushes their local economy and hurts everyday citizens? Or do they keep rates low, let their currency completely collapse, and risk a massive inflation crisis tomorrow? It's a total lose-lose scenario, and it's all triggered by a tiny decimal point change in Washington. Finally, conclusion, the end of the line. From the magic faucet, through the cruel seesaw, all the way to the global vacuum. So I'm going to leave you with this final thought to ponder. These absurd levers, these pulleys, these invisible transmission channels, they inevitably reach every single corner of your financial life. There is literally no hiding from the base rate. It finds us all. So the next time you see a central banker step up to a podium, clear their throat, and reach for that tiny little dial, ask yourself, is your portfolio about to be crushed by the seesaw or sucked into the global vacuum? Thanks for joining me on this explainer. Stay curious, and for the love of your net worth, keep a very close eye on those interest rates.